Hello friends, how are you? I hope you all are doing good. So let's continue with our discussion on budgetary control, and this is going to be the last lecture for budgetary control. With this, the budgetary is complete, right? Then we'll move on to the last chapter, that is service costing. So this is the last lecture for budgetary control. So we have covered a lot of budgets in this, right? We have understood a lot of budgets, and as you must have seen that there is nothing new to learn in this chapter of budgetary control, right? So before we start, subscribe to the channel, press the bell icon so that you get all the notifications on time, and check out the links in the video description for the website, for Android app, Instagram, Telegram, follow us everywhere, right? And all those who want to take the extra benefit of the handbooks, they can buy from the website, and some really good lecture courses available on the app also. Okay, now talking about the budgetary control, in the last lecture we discussed about the cash budgets and all, right? And I told you that there are some of the budgets like administrative budget, selling and distribution budget, and all those are basically the theory part. Now this is the handbook, our KSJ Teaching Handbook, right? So you will get all the theory part here, right? So administrative cost budget, selling, distribution cost budget, so you can read it from here, right? All those who are already having the books, you can read all this from here, right? Cash budget we have already discussed. Then master budget is what we are going to discuss in this lecture, right? So master budget is nothing but the combination of all the budgets basically, right? The master budget is the summary budget which incorporates all the functional budgets in the capsule form and shows the budgeted income statement for the budgeted period and budgeted balance sheet as at the end of the budgeted period. It sets out the plan of operations for all the departments in considerable detail for the budget period. Nothing but basically you have to consolidate all the things and prepare one income statement and the balance sheet, right? Whenever now we are talking about the income statement, right? See, I told you in the chapter of marginal costing also, sir, one is cost statement, right? One is cost statement. One we call it as cost statement, right? And another one is income statement. Another one is income statement, right? Sir, there is not a major difference in these two. The purpose of these two are the same. The difference is that whenever we talk about the cost statement, we start with the cost, right? All the cost we note down, then selling price, and then here we show the profit. This is the format of the cost statement as we have done in the chapter of cost sheet. That is a cost statement. Whenever we talk about the income statement, we start with the income, that is the sales value, right? We start with the sales value minus all the cost, and what we get is profit. The ultimate goal or the ultimate role is same for both, for cost statement and for the income statement. The only difference is the presentation, that how you present it. In the cost statement, you present it in the form of cost, profit, and selling price. And in the income statement, you start with the income. As per the name, you start with that thing. In the cost statement, you start with the cost, and income statement, you start with the income, that is the sales value. Clear? So this is how the income statement is prepared, or this is a sort of the master budget only, where we define our roles, where we define our income roles, that how it should be, what should be the sales volume, what should be the cost, to total everything, considering everything, right? See the sales. If we talk about the sales, we prepare the sales budget, right? Cost of goods sold, we prepare COGS budget, isn't it? Gross profit, other operating expenses, administration cost, administration budget, selling cost, selling and distribution budget, distribution cost, again selling and distribution budget, operating income, right? Gross profit minus operating cost, non-operating adjustments, add non-operating income, less non-operating expenses, less amortized expenses, income before taxes. You will subtract the income tax and income after taxes. After that, the appropriations out of the taxes, right? Whatever the income is left after the taxes, you will appropriate out of that. The dividends are paid, transfer to general reserve, transfer to specific reserves, and the final is profit and loss balance after all the appropriations, right? So this is basically a simple income statement that we have been preparing, that is sales Minus cost of goods sold will give you gross profit, minus the administration expenses, selling expenses, and all those expenses will give you the profit less taxes to be paid on the income, right? And whatever is left, you appropriate out of it and you get the profit and loss balance, right? This is from our book only, open page 16.12. It is given there, okay? KSJ Teaching Handbooks. All those who want, they can buy it from the website. This is the website. Okay. And the budgeted balance sheets are simple. The budgeted balance sheet anyhow will not be asked in the examination, but this is how the simple format of the balance sheet is, right? Asset side, liability side, simple. Total capital employed, working capital can be calculated, right? Assets, current assets minus current liabilities, that will be your working capital, right? So master budget is very simple. As per the information, just have to prepare the income statement, nothing much to be done in the master budget. So it is basically, I can say, very, very simple, right? Clear? So we have one question on this, question number 9. Let's do it. Y Limited provides you the following information related to the two products, product A and product B. Annual cost of goods sold is 1,57,100 and 1,47,000. Sales in units is 8,000 and 5,000. Selling price per unit is 30 and 40. Standard cost per unit. Selling price is 30 and 40. Standard cost of that product per unit is 19.50 and 24. Sales manager commission at 10% on the standard gross profit and 10% on standard gross profit for both the products. Now, what is the standard gross profit, sir? What is this? This term used has been standard gross profit. What is this standard gross profit? It is nothing but gross profit is what? Selling price minus standard cost per unit. Selling price is how much? 30 minus standard cost per unit, that is 19.5. In the other case, it is 40 minus 24. Whatever you will get is your standard GP, gross profit. Clear? This is standard gross profit. Other selling expenses 22,000. This is the total value, not given, the product wise. It is the total value that is given. Other selling expenses, distribution expenses, office and administration, tax 50%. After that, it is given that other selling expenses to be allocated to product A and B in their sales revenue ratio. What he's saying, that these selling expenses, obviously you will have to distribute between product and product B. Now, how this distribution should take place, the question says that they should be allocated in the sales revenue ratio, sales value ratio, not sales quantity. It is the sales value ratio. Distribution expenses to be allocated in the sales unit ratio. Now, this is in the ratio of sales quantity. So be very careful what is given in the question. Office and administrative expenses to be allocated equally to both the products, right? So other selling expenses given, distribution expenses given, and office and administration expenses, these are to be allocated equally. Prepare the budgeted income statement. So whenever we talk about the income statement, we start with the sales value. How? So sale units multiplied by selling price per unit, sales unit multiplied by selling price per unit. So this should be the first step. Let's see. Sales, product A, product B. 2,40,000 and 2 lakh, right? 8,000 multiplied by 30 and 5,000 multiplied by 40. Any doubts? No, sir. Cost of goods sold. Cost of goods sold is given as such, right? Cost of goods sold is given as such. So gross profit 82,900 and 53,000 less. Administration and selling and distribution expenses. Sales manager commission. How this commission? 10% on the standard gross profit. So gross profit per unit. 10% off. 30 minus 19.5. This is GP, gross profit per unit, multiplied by number of units, that is 8,000. Whatever you get this is the total standard gross profit. 10% of that will be your sales manager commission, right? This is for product B. This is for product A. This is for product B. Other selling expenses. Other selling expenses are, this is information is given that other selling expenses are to be distributed in the sales revenue ratio. This 22,000 is to be distributed in the ratio of 2,40,000 is to 2 lakh, right? Basically, how they have given 5% of the sales. Why they have given 5%? Total sales. What is the total sales? Total sales is 4,40,000. Total sales value is 4,40,000, right? Total this, what is the selling expenses? Total selling expenses is 22,000, right? Now selling expenses as percentage of sales, is 22,000 divided by 4,40,000 multiplied by 100. So this is 5% basically, right? So 5% of sales. So if the sales is 2,40,000, 5% of that, 2 lakh, 5% of that. Or what you can directly do is you can directly distribute this 22,000 in the ratio of 2,40,000 is to 2 lakh. That is absolutely correct, right? No need to calculate this if you don't want to. No need, right? Sir, what about distribution expenses? The question says distribution expenses to be done in the ratio of units. Now the units is 8,000 is to 5,000, right? How it is rupees 1 per unit? It is given in the solution rupees 1 per unit. So total here is 13,000. So if you will try to do the ratio, that is 13,000 divided by 13,000 multiplied by 8,000, right? And 13,000 divided by 13,000 multiplied by 5,000. So this is 1, this is 1. That is why it is 1 per unit, right? 8,000 and 5,000. Office and administration expenses to be divided equally as given in the question. So we have divided them equally. So whatever is left. So this is the total of administration and selling distribution expenses, right? This is the total of this. So net profit before taxes is gross profit minus this administration, selling and distribution expenses, less tax 50%. So net profit after taxes 37,800, right? This is the budgeted income statement. Clear? Simple, sir. Very simple. Nothing much to discuss or nothing new to teach in this thing. That is the most beautiful part of this chapter, budgetary. Nothing new to teach, right? Now, the last topic of this chapter is control ratios. Now, if we talk about this topic, control ratios, again 16.13 is the page. Control ratios, all those who are having the books, no need to write anything, guys. No need to write anything. Just relax, listen to it very carefully. That's it. So control ratios, whenever this topic has been asked, mostly it has been asked for 5 marks, right? Not more than 5 marks. In the first question, the compulsory question, it has been asked for 5 marks. Okay, so when we talk about this word ratio, ratio means relationship between 2 or more financial variables, isn't it? Relationship between 2 or more financial variables, right? So it is a relationship between 2 or more financial variables, right? So we have approximately 5, 6, 7 ratios that you need to understand, that you need to remember more or less, I will say, right? Because do not waste too much time in understanding. I'll try to make you understand that what is basically what is the relationship between the two things, between the two variables that we are going to use in each ratio, right? And a lot of things will be taking up from the standard costing. We have studied the standard costing. A lot of things we are with this control ratios, the parameters we are going to use, the financial variables that we are going to use, we have already done in the chapter of standard costing. So I'm going to refer to that. Okay. Now listen to the first one, that is the efficiency ratio. What is the efficiency, sir? If you want to judge the efficiency of something, what you will do, that for a particular task, what is the actual hours that you have taken versus what is the standards that you have set, right? If you want to complete 3 chapters of costing, what you will do for that 3 chapters, that is your output. What is the standards for that output and what is the actuals that you have attained for that same output, right? So what is important is output. For the same output, for whatever the actual output that you have attained, what is the standards for that and what is the actual for that? You will compare that. That is how the efficiency ratio, standard hours for actual output divided by actual hours multiplied by 100. It is defined as the standard hours equivalent to the work produced expressed as a percentage of actual hours spent in production, right? For actual output, standard hours for actual output. What do we call standard hours for standard output? We call them as budgeted hours. Remember, the standard hours for standard output, we call them as budgeted hours. So second one is activity ratio or the production volume ratio. It shows what you planned for, the number of hours that you planned for, that is the budgeted hours, and what should have been the planning as per the actual output, right? So this is standard hours for actual output divided by budgeted hours multiplied by 100. What you planned for and what should have been the planning as per the actual output. So that shows the production ratio or the activity ratio. After that, capacity ratio, what you planned for and how much of the actual capacity you have utilized. You planned for 10,000 hours, but actually you have worked for 9,000 hours, right? How much of the capacity you have utilized. So that shows multiplied by 100. Calendar ratio is budgeted number of working days in the budget period. You plan for that you will work for 25 days, but actually you are working for 23 days, right? So this is the calendar ratio. Whenever this word calendar comes, it always comes with the number of days, actual number of working days in the budget period divided by budgeted number of working days in the budget period multiplied by 100. Idle capacity. Idle capacity is budgeted capacity, and here you will take budgeted capacity minus actually whatever you have utilized, right? Multiplied by 100, or 100 minus capacity ratio. Whatever this capacity shows, whatever you have utilized out of the budgeted, out of the planned capacity, how much hours you have utilized, the remaining will be your idle capacity. So 100 minus capacity ratio will give you the idle capacity. Standard capacity usage ratio, that maximum possible hours in the budget period. Budgeted hours divided by maximum possible. Say the maximum hours I can work for is say 20,000 hours. But I have planned, as per my original planning, I will be using only 18,000 hours, right? So this is the budgeted hours 18,000, but still I have a scope for more number of hours because the maximum possible hours that I can work for is 20,000 hours, right? This is the standard capacity usage. Then is the actual usage of maximum capacity, maximum possible hours in the budget period, and how much actually you have used. Here we say how much actually you have planned for. Here we say how much actually you have used those hours, right? Out of the maximum possible hours that were available, right? Multiplied by 100. Clear? So these are the major ratios and that you have to do. Efficiency ratio, activity shows the budgeted bit and the standard hours. Capacity shows that what you planned for 10,000 hours, what actual capacity you have utilized. Calendar is budgeted and actual number of working days. Idle capacity is budgeted capacity minus actual capacity by budgeted capacity. Standard capacity usage ratio and the actual usage of maximum capacity ratio, right? So these are all the ratios that you have to remember. This one topic I can say you might have to remember, even if it is very simple. If you try to understand it, this is very, very simple if you correlate it with the standard costing, right? Like how you check the efficiency, sir. If you will, for a same thing, for a same output, if you are going to compare the standards and actual, you will get the efficiency, isn't it? So all these control ratios you have to remember, right? After that is given the additional theory part in the book. So you can read it. All those who are already having it, you can read it from the book. Everything that is given is really important, right? So this is all about it. Let's do one question on this control ratios and complete this chapter. Tulsian Limited manufactures two products X and Y. Product X requires 5 hours to produce 1 unit, while the 5 units of the product Y can be produced in 1 hour. Now, see how it is given. Product X requires 5 hours to produce 1 unit, right? If we talk about X, 5 hours for 1 unit, right? For product Y, he says 5 units in 1 hour. This is how it is given, right? For product X, he says 5 hours for 1 unit. For product Y, he says 5 units in 1 hour. In July of 24 effective working days. So in the month of July, you are actually working for 24 days, effective working days of 8 hours a day, 3000 units of X and 15,000 units of Y were produced. So this is the actual output. This 3000 and 5000, this is nothing but your actual output, right? Okay. After that, the company employs 100 workers in the production department to produce X and Y. There were 25 working days specified in the budget. So budgeted working days, 25. Actual working days, 24 in the month of July. Maximum possible working hours are 24,000 hours. This is the maximum possible working hours, right? Calculate efficiency ratio, activity, capacity, calendar, idle, standard capacity usage, actual usage of the maximum capacity, all the ratios you need to calculate, all the 7 ratios, right? All the 7 ratios you need to calculate. Let's see. What is this? What is the actual number of hours? 100 workers are working for 8 hours in 1 day and actual number of days they have worked for is 24 days, right? 19,200 hours. This is the actual hours. What you planned for? Budgeted hours. 100 workers will be working for 8 hours and 25 days. So this is 20,000 hours. This is your budgeted hours that you planned for originally, that we will work for, 100 workers will work for 8 hours a day and 25 days in a month. Whereas actually they worked for 24 days in a month. There is a difference between actual and budgeted. Now, what about the standard hours for actual output? This is your standard hours for actual output, right? Talking about X first. For X, what they are saying is 5 hours for 1 unit, right? And actual number of units manufactured 3000. Okay. For X, 1 unit, 5 hours. What about 3000 units? 5 divided by 1 multiplied by 3000. So 15,000 hours. Any doubt in this thing, right? 3000 multiplied by 5. Clear? Sir, coming to Y. Coming to Y. What about Y? What about Y? He says 5 units in 1 hour. And how many units of Y? 15,000 units of Y. So how many hours for 15,000 units? 1 divided by 5 multiplied by 15,000, right? 3,000 hours. See, 15,000 divided by 5. So total is 18,000 hours. This is the standard hours for actual output. So now you have calculated the budgeted hours also. You have calculated the actual hours also. And you have calculated the standard hours for actual output also. So efficiency ratio is standard hours for actual output 18,000 divided by actual hours, that is 19,200 multiplied by 100. Right? That for the actual output, the standard hours should have been 18,000. You should have taken 18,000 hours time, but you have actually taken 19,200. That shows that you are working at less than 100% efficiency. Clear? Activity ratio. Sir, standard hours for actual output divided by budgeted hours multiplied by 100, right? 18,000 divided by 20. Capacity. Out of the budgeted, out of the planned capacity, how much of the capacity you have utilized, right? 96%. Calendar ratio. Actual number of working days divided by budgeted number of working days multiplied by 100, 96%. Idle capacity ratio is 100 minus capacity ratio, 4%. Or budgeted hours minus actual hours divided by budgeted hours multiplied by 100. Standard capacity usage. Budgeted hours divided by maximum possible hours. Now see, the maximum possible hours are given in the question. 24,000 maximum possible working hours. Out of that, you have planned for 20,000 hours. So 83.33%. Actual usage. Actual hours divided by maximum possible hours, that is 24,000 given. Actual hours is 19,200 multiplied by 100, 80%. Right? So this is how the ratios are to be calculated. Basically, you need three things in the ratio. The first thing that you need is the actual hours, right? The second thing that you need is the budgeted hours. That means what you originally planned for. The third thing that you need is the standard hours for actual output, right? Standard hours for actual output. Clear? So with this, the chapter of budgetary control is over from my side. Now what you have to do is you have to practice the questions from ICAI study mat. Then you have to practice from RTP, MTP, past years, wherever you can practice from, right? And please download our Android app, because there we have a course where we have solved each and every question of the ICAI study mat. Plus we are coming up with a course where we'll be solving the RTP, MTP and the past year questions also. Right? So this one course is going to be really amazing course that we are going to launch in the coming days. So download the app, because we are going to send all the notifications there. Now listen to very carefully which all budgets you need to focus on. Right? More focus should be given on the first is the flexible budget. Flexible budget. That which all budgets need more of the importance, right? Then sales and production budget. These are very, very important. Sale and production budget. After that, raw material budget. Raw material, both usage and purchase. Then labor budget. Okay, right? Direct labor budget. After that, what else is there? Sales budget, production budget, raw material, production cost budget. Production cost budget. Then you have cost of goods sold budget. Cost of goods sold budget. Right? Production cost is done. Right? So these are the budgets that you need to more focus on. Right? These are important for 10 marks question. And if we talk about the control ratios, again, you need to do this control ratios. Do not skip this topic, because it has been asked multiple times. This has been asked for 5 marks normally, right? And in the 5 marks, normally it is asked in the question number 1. That is a compulsory question. I'm talking about the CA, as per the CA exam pattern, right? In the CMA, this might change, right? For the CMA student, this might change, or for any other subject. This I'm talking for the CA students, right? This is the pattern as per a CA student, but these are the important budgets that you have to cover, right? Now, last chapter of this series. Great, sir. Finally, last chapter of this series. We are going to start in the next lecture. That is service costing. Very interesting chapter. Easy, interesting, right? So you people are going to have fun. This is going to be the last chapter of this series. And sir, share with maximum people. That's what all I can say, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.